It is Friday. After 8 weeks of gains, we are on track potentially for an all-new record close at the end of today's session. 30 minutes till the start of the cash trade. I'm Matt Miller. Danny Berger is deservedly off today. Bloomberg Open Interest starts right now. Coming up, the S&P 500 heads for its longest winning streak since 2023, thanks to relentless AI optimism. Stocks also getting a boost from hopes of a U.S.-Iran peace deal, though major sticking points remain. And a day after the filing for the biggest IPO ever, SpaceX delays a critical test of its massive Starship rocket. Let's take a look at the stocks that have benefited from this incredible 8-week rally right up at the top. Intel, this is a look since March 30th, up 188% if you round up. Then you see SanDisk, Micron, AMD, Seagate, On Semiconductor, Western Digital. These are all the chip makers that have pushed the SOX index up to a 25 times earnings valuation. And meanwhile, the S&P 500 is on pace, as I said, for the longest winning streak in 8 years, driven at least in part by these chip makers. Bloomberg senior strategist Jan Patrick Barnard joins us now out of Frankfurt. And JP, I know that our stock story says, maybe hopes of a peace deal in Iran are helping as well. We've had those hopes for like the last 8 weeks, but it's really about the AI optimism, isn't it?
Yeah, absolutely. I mean, this story is still a big part of the market. What is going on? Of course, like the headlines for a potential deal in Iran is certainly helping. But I would argue, like over the past 8 weeks, the market like increasingly was not very worried about like the macro impact from higher oil prices and what it does to inflation, and the higher rates were like basically ignored. And everybody was so hyper focused on the AI trade and within that AI trade. And I think like we are now at the point where we're talking about concentration within concentration. The chip story was just like all over it. And I mean, like going forward, we saw a little bit of a rotation since last Friday, that people have like sold or take profit on that popular chips trade and moved a little bit more into other areas. I mean, like we're seeing Europe outperforming this week, for example. But like going forward, it's really like a question. This AI trade it's becoming so big and so dominant that really the question is like, how do we look at stock markets and how do we judge if a stock market is doing well or not when like half of it or even like 3/4 of it are just like one theme?
Yeah, absolutely. Concentration front and center, which is why the S&P 500, I mean, since a year ago is up almost 30%, whereas the equal weight index is only up 15%. That's the concentration there. You mentioned rates, and I know we do have today stocks up again, and we could hit an all-new record if we push over 75.01 at the close. Rates are down. Oil is lower than it was, 24 hours ago, and these two factors have been, I mean, somewhat important to equity indexes over the past couple of weeks.
Yeah, definitely. I mean, like I'm a little bit puzzled because everybody was talking about like, oh, the oil higher for longer. What does it mean for inflation? What does it mean for the Federal Reserve and also the ECB about in terms of cutting rates and helping the economy if there are any struggles? So do they have to fight inflation again? But it feels like that this discussion has become more of a sideshow, at least in the last 2 weeks or so, or last 3 weeks. And that people are not that scared anymore, and that, like, I mean, we have been there, that we said like inflation is probably going to be transitory, but I feel like this is the consensus again. We're going to see a little bit of an inflation spike, but it's not going to be too big. It's not going to impact earnings that much. I mean, like corporate commentary during the last earnings season was all right. Nobody was like, oh, inflation difficult, the consumer difficult. There was some weakness in consumer stocks, but it's not that the talk on the street is like massively, oh, inflation is going to be a problem. Maybe the market is wrong here, but it feels like investors right now, they have their eyes on it, but they're not overly concerned.
Right. I mean, we've had a little bit of concern in outlooks from retailers like Walmart and Target, but it hasn't stopped the broader market, or maybe I should say the narrow market, from rallying hard. JP, great to get your take. Thanks very much. We have a 3-day weekend here in the U.S. I think you only have 2 in Germany, which you have far more holidays than we do anyway throughout the year. Sources tell Bloomberg that the UAE has joined Saudi Arabia and Qatar in urging President Trump to give diplomacy with Iran more of a chance and avoid a return to hostilities. President Trump spoke yesterday.
We have total control of the Strait of Hormuz, as you know, with our blockade. The blockade's been 100% effective. Nobody's been able to get through. It's like a steel wall. And this is with the Iran conflict. That'll end soon, very soon. And when it ends, your gasoline prices will go down lower than they were before.
Joining me now is Bloomberg Washington correspondent Tyler Kendall. And President Trump, it's questionable whether we have total control over the Strait of Hormuz, right? If we did, I think it would be open. But what's the likelihood that we move towards some solution over the weekend in the next week, Tyler?
Well, Matt, at this point, we're getting some mixed signals from both the U.S. and the Iranian side. Yesterday, we heard from Iranian state media that there had been some progress made in bridging the gaps in the latest U.S. proposal. And I will point out that Secretary of State Marco Rubio addressed reporters earlier today where he said that, quote, slight progress has been made. It appears that perhaps we could be moving towards a deal that would first see a reopening of the Strait of Hormuz and then postpone negotiations around potential curbs on Iran's nuclear program towards a later phase of any perhaps longer lasting peace deal. The thing is, yesterday, we really saw some of the biggest points of contention come to the forefront as Iran's foreign ambassador to France told Bloomberg News that there are these active discussions to get a permanent toll system underway when it comes to the Strait. The Secretary of State said that that would mean any U.S.-Iran peace deal would ultimately be unfeasible. Then you also had Iran's supreme leader yesterday, according to Reuters, saying that that stockpile of highly enriched uranium isn't going anywhere. And Matt, we know that that is one of the big sticking points for the U.S. So it is hard to tell right now if the sides really are getting closer to any potential longer-lasting agreement.
But there's no, in terms of a return to hostilities, Tyler, I know the president said last week that he had planned on going back to war on Tuesday. There's no, that we know about, immediate plans to continue or restart attacks.
No, not at this point, Matt, though President Trump did say that he was going to give Iran a limited amount of time. He indicated earlier this week that that could mean the beginning of next week. But it is very clear that the White House here is trying to pursue a diplomatic solution amid what has been mounting political pressure, of course, here in the U.S., especially as we get closer to the midterm elections. And I will also point out, as you mentioned at the top there is this mounting concern from regional allies about what Iran retaliation could look like if the U.S. does escalate militarily. In fact, we have new reporting out from Bloomberg News about how the scope of Iran's retaliation is raising some concerns because it appears that Iran could be relying even more on some militia proxy groups after the UAE was hit with a drone at one of its largest power plants earlier this week, appearing that drone to have come from Iraq. Now, neither Iran or its proxy groups took responsibility for that attack, but it is definitely raising some alarm bells from our regional allies about just how far-reaching Iran's retaliation could be if the U.S. does choose to escalate in such a way.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there in Washington. Now, a little bit further south and west, SpaceX's launch attempt for its massive Starship rocket was delayed again last night. Elon Musk says there will be another launch window this evening following the company's IPO filing this week. Bloomberg Tech's Ed Ludlow joins me now for I would say normally the exciting stuff. The rocket launch, Ed, I think is the exciting stuff. Normally, like an S1 or IPO filing is the boring stuff. In this case, I think that may have overshadowed. But what happened last night? What went wrong with the rocket? And how likely are they to pull it off tonight?
Yeah, so it's a brand new launch pad in Starbase, as well as a brand new architecture for Starship. And if you think about the tower that's on the pad, I don't know if we have pictures of it on the pad. There's an arm that extends from that tower that's behind Starship and attaches to the rocket, and it's held in place by a hydraulic pin. And so for all the drama and all the anticipation, this is a really big deal, and we can get into why. It was just a piece of metal that failed in the end. But as you I think you know really well, why do we care so much about a new version of Starship and a test flight? Because if you read the S1 very carefully over and over again, all of these science fiction predictions that SpaceX is making for its future business lines, they are all predicated and completely dependent on that system working and being reusable. On paper, it's the only launch system capable of putting payload into orbit at a level that will sustain like orbital data center or take humans to Mars, but in the first instance, the moon. And so it does really matter. Yeah, I mean, I think it's so fascinating. This Starship rocket is so massive, it could end up carrying 100 or 150 tons of commercial payload into space. But the total addressable market that SpaceX suggested at $28 trillion, actually the lion's share of that has nothing to do with bringing payloads into space, does it? Yeah, so the breakdown is total addressable market, 28.5 trillion. Artificial intelligence is 26.5 trillion. So the delta, the 2 trillion in between, is Starlink, the business of space-based internet and direct-to-cell service. And if you dig even further down into that chart, what SpaceX is saying is that actually they see the large part of their future in terms of how they make money being akin to OpenAI and Anthropic, selling artificial intelligence as an enterprise software product. And that is fascinating. But to do that, they need to build data centers in the form of satellites, put them into orbit. They still have this core guiding mission of making humankind a multiplanetary species. All of it does not happen. It couldn't be more clear from the S1. If that Starship system doesn't work, but also if it's not reusable for the economics of it to work, then none of that happens. All right, Ed, great to get your take. Look forward to more coverage of these rocket launches with you. Ed Ludlow from Bloomberg Tech. His program kicks off at 11 a.m. as usual today. Check on markets here. We're looking at a renewed rally here, or a continued rally, I should say, on the S&P right now, 0.5%. The futures gain, the NASDAQ also gaining 0.5%, and the 10-year yield coming down. That helps. You can see Brent crude. Right now it's rising 17 cents from the close, but it's still far lower than it was yesterday at this time. So 102.72 seems like a cheap price for Brent, considering what we've seen over the past couple of months. Let's get a look at some of the other individual movers on our radar. Chinese regulators plan to fine 3 brokerages for illegal cross-border businesses, including Tiger and Futu. Estee Lauder shares moving after talks to merge with Puig brands fell apart due to compensation demands from Charlotte Tilbury on the Puig end. And Workday earnings topped expectations and defied fears around AI's impact on the software company. This has, I think, been one of the most interesting stories of the SaaS apocalypse, because all of the big AI companies pay Workday to use their software. IMAX gaining after the Wall Street Journal reported the large screen theater company is exploring a sale and has approached entertainment companies as a potential buyers. We'll follow that story for you. Now, coming up, Chrysler is making a comeback of sorts, but with cheaper SUVs. You're looking at the all-important Pacifica there. That's the only vehicle that Chrysler currently sells. We'll talk about how much more they could broaden it out. Next, this is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. The Late Show host Stephen Colbert signed off from CBS with a celebrity-packed finale that mostly avoided politics and jokes about President Trump.
We love doing this show for you, but what we really, really love is doing this show with you. Now, I'll say to you what I've said to every audience for the last 11 years, and I have meant it every time. Have a good show. Thanks for being here. And let's do it, y'all.
CBS says the cancellation was, the driver was financial, though Colbert recently blasted Paramount over its settlement with President Trump. Miami is emerging as the World Cup's hottest host city. Lionel Messi fever in South Florida, demand from Latin American fans, and premium matchups are driving up ticket and hotel prices. Meanwhile, some cities are worrying about weaker tourism demand other than Miami. In New York, hotels have sold 18% of available rooms. At this point last year, that figure was 26%.
And Stellantis is rebooting Chrysler with 3 new SUVs, with 2 of them priced under $30,000. As inflation squeezes car buyers, the automaker says it's finally returning to the affordable market after years of chasing luxury-level profits. Chrysler, now down to minivans only, one minivan, hopes the cheaper crossovers, the broader product offering, can revive the fading American brand. Let's talk more about that. Joining us out of Detroit is Bloomberg's autos reporter, Gabriella Coppola. She was at the company's capital markets event yesterday. Gabby, I was so bummed to miss this. Last time I went to one, it was FCA, and I was interviewing Sergio Marchionne about why they couldn't put a stick shift in the 4C. In any case, what do we know? And by the way, that was an Alfa Romeo. Let me start out with that, because that's, for car lovers, such an important brand. What's going to happen with Alfa Romeo?
Well, they are talking about, putting out some new models. I think the big strategy yesterday was that they are going to focus their investment on 4 key brands: Jeep, Ram, Peugeot, and Fiat. But then they're going to kind of try to leverage those investments to, feed their other smaller brands that are more regional, that don't have as much scale, and Alfa would be one of them. So they are going to put out some new product, but it's kind of, I think it kind of remains to be seen how different this is from the previous minutes, because previous plans, because they've always, Stellantis has 14 brands, and the thing that Wall Street is pressuring them about is, why don't you just kill off some of these brands? But they don't want to, because people love them, like people love it, but they just, they got to work within their means here. And
they have to sell, obviously, less expensive cars, right? I was just, as we saw, driving the Alfa Romeo Tonale, but I've driven a lot of their cars with price tags, for example, the Grand Wagoneer, that stretch way over $100,000. And right now, inflation hitting Americans hard. They can't afford to buy new cars. What's with the lower priced offerings coming out of brands like Chrysler?
Yeah, so even that $100,000 Wagoneer has been repositioned to be more affordable. And I think you've seen that across the portfolio, definitely with Jeep, with Ram, and now with Chrysler, bringing back Chrysler. This is a huge deal, because as long as I've been covering the auto industry, which is almost a decade, people have been talking about new product for Chrysler, and we never saw it, So they're going to bring back 2 models that are going to be under $30,000. They're going to be, it's like the Chrysler Aero and the Aero Cross. And then there's going to be a step up from that called the Chrysler Airflow. And they're positioning this as, they say none of the Detroit automakers are really in this space. It's kind of dominated by, Asian automakers, Hyundai, Toyota, Honda. They're going to try to use Chrysler to get back in there and kind of recapture that entry-level buyer that they lost in recent years, because they did focus so much on the upscale premium, tricked out Jeeps, the highest trims, the, Wrangler, Wagoneer, Grand Wagoneer, very, luxury pickup trucks. The trucks can be a luxury car. So I think they are recalibrating to adjust to the kind of affordability crisis that we are having in the U.S. car market right now. Yeah, absolutely. I've spent time recently in the Ram RHO, which is incredibly luxurious, and that is a pickup truck. The TRX, obviously the dream with the Hemi. Chrysler made the Hemi famous back in the day, but everybody associates it now with Dodge, and they're bringing that back. What do we know about the new product offerings from Dodge? Oh my gosh, there's so much, Matt. There's a lot. So first of all, on the affordability theme, okay, well, actually, let me be careful there, because I was starting to talk about Ram, but let me talk about Dodge. So with Dodge, I think the most exciting thing we saw was there's going to be a new sports car called the Copperhead. We just got a sneak peek of it yesterday at the Auburn Hills, at the company's kind of sprawling campus outside Detroit. It is a sexy, curvaceous, people might compare it to the Viper, but CEO Antonio Filosa said this is not the Viper, but it's different. But I think it's going to be something more accessible. It's going to be more, again, with this issue of affordability. They've brought back the ICE version after kind of disastrously killing the combustion engine, putting a stake in the heart of the things that you love, Matt, under the previous CEO. They phased out ICE muscle cars. Now they're bringing those back. But I want to mention also the big news here is how much they're expanding the Ram lineup. There's going to be a Ram SUV, which we haven't had for over 3 decades, called the Ram Charger. And there's going to be a midsize and a compact pickup truck. The Dakota, Ram Dakota, that's a midsize, and they're going to bring the Rampage, which is a compact pickup. So again, making cars smaller to get people into things that they can afford, but they can still make a decent margin. That's the plan.
I think I agree with you. The Ram Charger is the most important news from all of their, what would you say, 13, 14 brands, because all the other American brands, GM as well as Ford, have, you know, a 3-row body-on-frame SUV, and Ram hasn't had one for so many years. So, okay, Gabby, we'll have to talk about this offline. My producer's saying that's enough of car talk.
That's enough car. Okay. Thank you, Matt.
Bloomberg, Gabriella Coppola out of Detroit. Listen to my podcast, by the way, if you want more car talk. It's called Hot Pursuit with Hannah Elliott, and we do spend a lot of time talking about my Dodge RT Challenger Scat Pack wide body. Coming up, we're going to talk with Sarah Hunt from Alpine Saxon Woods. This is Bloomberg. Check on markets ahead of the opening bell. We're looking at continued gains here. 8 weeks. We're going to finish out this week with the gain as well. So 8 weeks of gains, the longest streak since 2023, fueled by the incredible growth in AI that we saw evidenced by NVIDIA this week. So S&P futures up 0.4, NASDAQ futures as well. We do have yields coming down, which helps. That's a tailwind, and crude also a much lower price than we've seen throughout the rest of the week at 103.18. When we come back, Sarah Hunt of Alpine Saxon Woods joins us to talk about this rally. This is Bloomberg. We are moments away from the start of trading on this Friday. This is Bloomberg Open Interest. I'm Matt Miller. We see futures higher ahead of the opening bell, 0.4% on the S&P and the NASDAQ on continued optimism for artificial intelligence. The growth that we've seen from the likes of NVIDIA has been just absolutely enormous. I mean, still putting up 85% year-over-year revenue growth. You got to give them some credit for that. Ringing the opening bells are a couple of foundations here at the NASDAQ market site. Another Fedora Day. These are the ladies who supply flowers to all of the monuments around the country. Remember, Memorial Day coming up, and as a result, we've got the American Battle Monuments Foundation ringing the bell at the New York Stock Exchange. More importantly, well, not more importantly, broadly, but for us, since we're focused on stocks, let's take a look at the winners of the S&P 500's longest weekly winning streak since 2023. On the Bloomberg terminal, I use the MRR function. That stands for Members Ranked Returns. I look at the S&P 500, and then I put in the starting date of March 30th. So that was basically the first trading day 8 weeks ago. And you can see since then, Intel is up 188%. SanDisk is up 170%. Micron is up 137%. And Micron is still only trading at 8 times forward earnings. Let's bring in Alpine Saxon Woods Chief Market Strategist Sarah Hunt. These gains in 2 months, if you see those kind of gains, that looks absolutely bubblicious, right? But we don't, the valuations for these companies are not really sky high.
Well, I think that part of the reason you're seeing so much enthusiasm is because they're really making a lot of money right now. The question becomes, can they continue to make that amount of money? And when do we start to see that infrastructure shift to other parts of this entire ecosphere that is surrounding AI, and what that looks like going forward? Right now, we're still in the gold rush days, and everybody is running to take advantage of what is working. In the end, you could see this go on for a couple of years because there's a lot of work that needs to be done, and there's a lot of ancillary work that needs to be done. I think you're going to end up with power as part of the chokehold, but we'll see how that goes, and we'll see what efficiencies can be done out of those chips. And I think that's what people are looking for, too, is another iteration of innovation. So
how do you see this broadening out? I mean, we've already seen run-ups in companies that you wouldn't think of as AI companies, right? Caterpillar and Deere are now an AI play. The Ford Motor Company may be making giant storage batteries for the hyperscalers. Companies that make boilers all of a sudden are on an absolute tear in the stock market because you need to have, HVAC systems for these data centers to work.
And a lot of that is also about the energy component that we need. And there's a lot of discussions about the linear extrapolation of how much energy we need per data center. And I think that that's where you're going to see some innovation. You're going to have to see some innovation change that, because if you extrapolate that on a straight line basis, we're not building power plants fast enough, and it's too difficult to permit. There's a whole list of reasons why that's an issue, and power prices are going higher, and that's difficult for consumers on top of everything else. So there has to be some change in that technology, and I think people are expecting that will happen, and therefore there will be some other game changers that will jump into this. But right now the enthusiasm is very high.
So, I mean, if you're invested in this market already, you've done quite well. We were talking to an investor yesterday who owned NVIDIA, and we said, so are you buying new shares? And she said, no, I'm already overweight NVIDIA. Like pretty much everybody is, right? Where are you going then for more exposure? Where are you going to with new money to take part in this broadening out?
So we've always been centered on a lot of cash flow metrics and a lot of balance sheet metrics, as well as in some cases dividend and buyback metrics. For some of these stocks, you have an opportunity that works there. For some of them, you don't. So the other parts of the market, there are places that are doing fairly well. And the difficult thing here is that there's been a lot of, like, you look at things like med tech, and you look at things like biotech is working, but med tech is sort of slowed down. There's a lot of areas where things are kind of cheap relative to the rest of the market. So it's a little bit, I hesitate to use the word barbell, but I think you have to have some technology, but there are places that you can look and you can say to yourself, you know what, relatively speaking, I got a good yield here, I got good earnings here. There's some places where you can find some value in this market.
Please continue to hesitate to use the word barbell. No, I'm kidding. I get what you're saying. In terms of the AI threat, are there companies that really have problems? Like, I was sitting in a car with the people from Dolby the other day, and their stock has tanked. We're going to talk to the CEO of Axon later, which makes not only tasers famously, but also software that works with AI. Their stock has tanked. Like, why a lot of these companies that you would think are going to be helped by AI are really hurt?
I think that that's part of the ecosystem of trying to understand of where it fits in. Is this something that's going to take over what somebody's doing, or is this something that's going to enhance it? For companies where you have to have seat growth or you have to have more user growth, the question is, do I need as many users? So that you had that sort of SaaSpocalypse aspect that was going on before. Now people look at things and they go, oh, it's going to get disintermediated, but we're not exactly sure how. And to the extent that a lot of these things need to work together, there's probably opportunity in some of that knee-jerk reaction. It's hard to figure out in that moment what is coming for which company and how that's going to, can you add it into what you're doing, or is this something that is actually going to take over some of the tasks that you do? And I think that that's where people are looking to try to understand how it fits in.
By the way, I was listening to the remix of Elton John's Rocket Man with Dolby Atmos technology, and it is astounding how different and how good that song sounds in Atmos, at least in a Cadillac Escalade IQ, which has like 26 speakers. But I mentioned that because of the Rocket Man IPO that we were all following so closely the last couple of days. What do you make of this? SpaceX, I mean, when it comes out, does everybody have to, we all sort of have to buy it, right? It's going to be included in the index. NASDAQ 100 at least straight away.
I think that that's going to give it a natural market. I think there's a natural market for it anyway, because people are very excited about all the possibilities that this opens up. Again, there's a lot of sort of challenging new frontiers things. There's a lot of great stories that you can hang around this, and you can look at markets and say that there's a giant addressable market. Until you narrow that down and until you start seeing how that works, it's hard to say. And honestly, you watch that rocket take off and get caught by something, and that's actually kind of, it's just amazing from a technological standpoint that somebody could get that all to work properly, so that it's hard not to see why there's so much enthusiasm. Whether or not the valuation and the enthusiasm are at odds with one another is harder to say, but you can see why people get excited.
But I guess you, as an investor, you have to take that ride at least for a little while, right? Even if you're concerned about what happens to SpaceX's valuation a year or 2 years down the line.
Well, I think if you're mirroring an index, yes, and if you're sitting passively and it's going to be part of an index, you're definitely taking that. As somebody who can look and be on the active side, you can take a stance on whether or not you need to do something in that moment, or you need to do something as things play out, so you can see a little bit of what's going on. It gives you more ability to decide, as opposed to it's going to happen because by definition you're in an index and that index is going to include it.
All right, Sarah, great having you on. Thanks so much for joining us. Hope you have a fantastic Memorial Day weekend. Alpine Saxon Woods Chief Market Strategist, Sarah Hunt. Let's get a look at the stock market right now and the cash trade. We continue to see gains now, 74.93, the level on the S&P. Remember, not that it matters, but the all-time closing high last week was 75.01. We're up about 2/3 of 1% with pretty positive breadth. 362 gainers, 139 losers. Right now, we're looking at, on the winning side of the ledger, obviously most of the companies, but led by Apple, AMD, Microsoft, Broadcom, and interestingly enough, Tesla. Now, we're looking at in terms of a breakdown in points. So these are the companies adding the most points. The companies taking points away. Micron, but it's only taking away 0.6 of a point right now. It's only down 0.2 of 1%. You can see Google bouncing up and down there, SanDisk as well. So these are companies that have done incredibly well, Exxon Mobil, and are maybe a place for investors to take some profits right now. Let's look at a breakdown by industry group. It's early in the session, but all of the industry groups are gaining right now. Healthcare, consumer discretionary, and IT leading the way. And the question is, do investors want to continue holding this kind of risk into the weekend? Whatever happened to sell in May and go away? Not that that has worked incredibly well. Coming up, Citi's Stephen Zaccone joins me to discuss the retail sector navigating higher fuel costs and increasingly cautious consumer. We were talking about that with JP Barner a little bit earlier. This is Bloomberg Open Interest. Time now for our top call. Some of the analysts' action in focus this morning. First up, JP Morgan is upgrading Sweetgreen, saying the management reset is successfully moving from tech-heavy bets towards stronger operations and new menu items that customers want, including wraps, apparently. Next up, UBS is upgrading Alcoa, saying Middle East smelter outages should keep aluminum prices and premiums stronger for longer, offsetting short-term demand risks and weaker pricing. And finally, Seaport Global is upgrading Texas Instruments, saying rising data center power demand is reshaping how electricity moves inside facilities and should drive a surge in demand for analog chips, expanding the market and lifting margins. Now, retail earnings this week showed that inflation is impacting the bottom line and especially the outlook. Executives from companies including Walmart, Target, and Home Depot all warned that higher fuel costs are eating into earnings because consumers are having trouble making those payments. Let's discuss the theme more broadly with Citi retailing and hardlines analyst Stephen Zaccone. Stephen, it's interesting that the market doesn't seem as concerned about broadly as concerned about inflation as these retailers do. Obviously, the consumers are their bread and butter. How serious is the issue?
I mean, it's a problem for lower income consumers. Thanks very much for having me on. You know, we've definitely heard about the K-shaped economy for some time, and I think that continues to be the theme. You know, we had a plethora of earnings reports this week from big box, home furnishings, auto parts retail, right? And I think you're getting a picture of the consumer being resilient. You're getting a picture of the consumer from the top of the K-shaped really outperforming. They're doing the best, right? And I think the lower income consumer is where things continue to be choppy. I would say we're focused on gas prices being high, but it's not at a $5 nationwide level. Feels like there could be an opportunity for that to come down if we get geopolitical tension easing. But there's a lot to monitor at the moment.
I'm looking through your coverage universe, and I see certain companies where I think, BJ's Wholesale, for example, maybe the higher end consumer steps down and spends more money there than he or she does at, a name brand grocery store. We've definitely seen that with Walmart, right? Are you seeing it at places like BJ's as well?
Warehouse clubs are a share gaining story overall, right? You've seen more and more traffic go to that box. BJ's is down today, some more of the margin specific details. But underlying trends in the warehouse club space continue to be very strong. We have seen some sort of trade down from the higher income consumer when you get into more of the grocery purchases. That's fair. I would say more broadly, though, BJ's has a little bit more exposure to lower income too, and that's where things have been a bit choppy, and there's a cautious view going forward.
What about the more luxury-leaning names, or something like Williams-Sonoma? Only if I were feeling flush would I go and drop serious coin at that store, right? I would love it because I enjoy cooking with the products they sell, but they're expensive. So how are they doing?
They're doing really well, to be honest. They reported yesterday, and their comps were up 4.8%, right? The home furnishings industry is down low single digits. So they're really outperforming. It's the strength of their brands. They talked about the K-shaped economy. We're at the upper half of the K-shaped economy. And, our consumer is not necessarily as impacted by the price of gas. So they've seen pretty good trends, and it's really bucking the trend of the housing market, being weak from a housing turnover perspective. So they've been performing very well. They've got that exposure to that upper income consumer. And I think there's innovation in the category, right? They've got the good brands to come in and shop. So they're doing a very good job right now in this environment.
When I'm strapped for cash, Stephen, I want to keep the cars I have running longer rather than buying new ones. I'll go to AutoZone and buy new bushings, control arms, sway bars. Is that happening now?
Yeah, I think that's a good sector to be in. Auto parts retail, the AutoZones, the O'Reillys of the world, those are always good sectors to be in from a consumer perspective. That's continuing. The story there is they've had a lot of inflation from tariffs. That's continued to be passed on to the consumer. The consumer's actually been, able to deal with that because you've probably been prioritizing repairing your existing vehicle. So they continue to be good areas of having exposure for consumer spending. As we look into next week, AutoZone reports, we're thinking same-store sales growth continues to be in the up mid-single-digit range, right? So very impressive performance when you think about consumer spending there.
What about those that are tied to housing? I mean, you cover both Lowe's and Home Depot, so I'd love to hear your take on those two and the competition that they have, but also a higher-end play like Restoration Hardware. You've got to have serious cash to buy some furniture there, so I'm guessing that the higher end of the K is doing well supporting them.
Yeah, home improvement's an interesting place. We had a recent upgrade of Lowe's to buy. The thesis is basically, as you think about higher gas prices hurting some discretionary spending for consumer, the home improvement space, it's been challenged for some time. So there's not as much earnings, risk when you look at the home improvement space. Depot versus Lowe's, we can kind of debate some of the differences. Home Depot is getting a lot quicker into the large pro, complex pro opportunity with some of the building products acquisitions. I think Lowe's has done a good job gaining share in the small to medium pro opportunity. That continues over time. Good margin expansion story there as well once we get back to better same-store sales growth. RH is an interesting one. We're neutral on it. We've recommended it for a long time. We've been neutral for quite some time. It's much more of an idiosyncratic story there, where you used to have this attractive opportunity in terms of gaining share in home furnishings. And now the story has got much more complicated with international being a lower profitability channel and not needing to see improvement, over in the European stores. They also have some new collections that are launching that it's TBD whether they'll be successful. I think they're optimistic, but we'll have to see how that all plays out as we go over the course of the year. So it's a much more complicated story. Plus, you've got a lot of balance sheet leverage that you didn't always have in the past. Sonoma is a much cleaner way to get exposure to home furnishings, and they're executing at a much better level.
If you're downtown, and you are downtown, Stephen, Restoration Hardware has a fantastic rooftop restaurant at their New York headquarters. Highly recommend checking it out. Maybe something to do on this rainy Memorial Day weekend. Stephen, thanks so much for joining us. Citi Retailing and Hardlines analyst Stephen Zaccone talking to us about the retail universe. Coming up, NYSE President Lynn Martin questions Wall Street's rush to rewrite IPO rules, just as a SpaceX listing could unleash billions, tens of billions of dollars in passive fund demand. That's next. This is Bloomberg Open Interest.
Market integrity is not something that is a competitive dynamic, and some of the rules that have been changed to woo some of the large companies, you referenced SpaceX, are are questionable. And from our perspective, what is most important to us is protecting investors. To be honest, I just don't know what effect this is going to have on the market.
NYSE President Lynn Martin speaking on Bloomberg surveillance. The SpaceX IPO may already have tens of billions of dollars in automatic demand lined up because of passive funds. Joining us now to talk about this is James Seyffert, ETF analyst for Bloomberg Intelligence. And James, I've been reading, your research and the research of Rob Duboff on this, which is absolutely fascinating. I think Rob estimates there could be $48 billion of automatic buyers here in a $75 billion IPO. That's obviously well over half. What do you think?
Yeah, I mean, so what this comes down to is the main three indices we looked at for this research were the Russell 1000, or the Russell universe of indices, the S&P universe of indices, and the NASDAQ. The NASDAQ is the only one that's fully finalized on these rules. And I mostly agree with what she was saying, right? Like, I can make arguments on both sides here, right? One is like, why are they making all these rules to bend over backwards to get these things on? For NASDAQ, it makes sense. They want the SpaceX listing, and they got it, right? For some of these other indices, it's more like, why are they doing this? And there's probably good reason. I mean, these things aren't like new IPO'd companies coming to market at $100, $200 million, maybe even $1 billion, you can make the argument. Like, this thing is looking like it's going to IPO at $1.75 trillion. And the market has changed, right? These companies are not coming to market as young companies. They're coming to market as almost pseudo fully formed. So it kind of makes sense to kind of change the rules a little bit to add these things quicker. But maybe they might have gone a little bit too far, as a lot of people are saying and writing.
Yeah, I mean, I understand also why NASDAQ or other index operators would want to change the markets, right? You want to attract these listings to your venue so you get the money. But are they putting market stability at risk?
Yeah, that might be a little bit too far. I think it's a little interesting. Like right now, if we look at the passives and the Russell consultation, the S&P consultation actually goes through and they do add these things. Within the first 6 months, we're talking about 24%-ish of a $75 billion float on SpaceX that would get bought up. You add in the active managers that are benchmarked against them. If they want to get flat, basically, if you're benchmarked against an index and it goes in at whatever weight, even just to get flat, you have to buy, an additional more. So that would take over 50% of the float that came to market. So there's some concerns around that would happen after 6 months. But I think it kind of makes sense, like I said, that you want to get these in the indices. And they have done things to limit it. The NASDAQ has limited how big the weight could get because unlike the S&P and unlike Russell, which is float weighted, so basically the company is weighted by how much of the shares are actually public, the NASDAQ doesn't do that. So they've instituted other ways to limit how big it could get at these things. But they have waived, there's all these requirements on how much float is required, public voting rights, and it seems like they're going to waive those, and NASDAQ has waived those float requirements to get this thing into the index.
By the way, just 30 seconds, but the voting rights has to be a concern, right? I mean, public voting rights for the SpaceX IPO are going to amount to like, what, 3% or less?
Yeah, they're all these consultations, and NASDAQ has already waived those requirements. So they're going backwards on governance and things like, ESG was huge a couple years ago, and this is kind of going backwards on those things a little bit.
CalPERS and TIAA-CREF are going to have to own this, and there's going to be horrible corporate governance.
Yeah, and it's likely going to go to market at 90x price to sales.
All right, James, great getting your take. Love your research on this. James Seyffert there of Bloomberg Intelligence. Tune in to ETF IQ, by the way. That's on Mondays at 12 noon New York time to hear more about the big ETF news. No, not Monday? Now 1 hour Mondays, but not this, obviously, because it's Memorial Day. So next week, it'll be on Thursday, and it's a show you don't want to miss. We are 30 minutes into the trading day, and it feels so chill because futures are up. The AI demand is insatiable, and everything is set for Memorial Day, except for the weather. Welcome to Bloomberg Open Interest. I'm Matt Miller. Danny Berger is off today. The S&P 500 is heading for its longest winning streak since 2023, thanks to that relentless AI demand. Stocks are also getting a boost from hopes of a U.S.-Iran peace deal, though That's every week, and it doesn't seem to happen. And Kevin Warsh takes over at a tense moment for the economy and the Fed, and in a pretty unique way. He'll be sworn in as chair in the next hour, but not at the Fed. It'll be at another building where they're spending billions of dollars to renovate. We begin, though, with breaking economic data crossing the terminal. University of Michigan consumer sentiment. This is the final reading, and we're seeing the sentiment even worse than had been anticipated, the inflation expectations even higher. Let's break it down with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what do you make of the numbers?
All-time record low for the headline number of 44.8, and it's a big drop from the preliminary number of 48.2, which was bad enough. Current conditions are seen at 45.8, down from 47.8, and expectations 44.1, down from 48.5. Americans are not happy. Inflation, as Matt mentioned, 4.8% is the forecast in consumers' minds for one-year inflation, and for 5 to 10 years, 3.9%. Those are both up significantly from where they were. And this becomes even more important, Matt, because we have headlines coming out from Fed Governor Chris Waller, who was one of the first people to vote for rate cuts. He's now saying he's prepared to vote for rate increases if the war goes on and inflation does not come down. Here's a line from his speech. I can no longer rule out rate hikes further down the road if inflation does not abate soon, and that is especially true if measures of inflation expectations, some of which have risen lately, show signs of becoming unanchored. Well, maybe there's a little bit of that in the Michigan numbers. Now, he's obviously going to be looking at the break-evens on Wall Street as well, but it is a condition now, an inflation condition now that worries even Chris Waller. And even more interesting, he does this 1 hour before Kevin Warsh is sworn in, and the president's goal, of course, for Kevin Warsh is to cut rates. Doesn't look like we're going to be getting there anytime soon.
By the way, as far as I understand it, normally a new Fed chair is sworn in at the Fed building in Washington, D.C., where they've had massive cost overruns in their renovations. Now, Kevin Warsh is going to be sworn in at the White House, where they've had massive cost overruns and renovations?
It's not unprecedented, but it is unusual, put it that way. It's rare to do that. We haven't seen it but more than once, perhaps, in the past. But the symbolism is going to be hard to miss, and that is the president who says cut rates swearing in his new Fed chair. It'll be interesting to see if the president says anything to try to give Kevin Warsh a little running room. He's already said he's going to let him do what he wants, and Scott Bessent, the Treasury Secretary, has said, well, maybe they can't cut rates right now. So we'll be looking for kind of remarks along those lines. And then what is it that Kevin Warsh is going to say, and how much is he going to lead the markets? So fascinating, and that's scheduled for 11. We'll, of course, have it on here on Bloomberg TV, but it is Trump time, so we're not exactly sure whether it starts at 11 on the dot.
Mike, thank you so much. Michael McKee, there, our international policy and economics correspondent. Let's continue this conversation with Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, we've had, as Mike just pointed out, record low in terms of consumer confidence, according to the University of Michigan. And as we were talking about in the last hour, inflation concerns, higher gas prices have really hit the outlooks for companies like Target and Walmart. What do you make of the U.S. consumer?
Hi. Well, so far we have seen resilience. Consumer confidence, of course, according to a number of surveys, is very low, but we're not really necessarily seeing that very clearly pass through into spending habits. That's not to say that it won't happen. There's only so much resilience that we can expect. Balance sheets certainly are very strong. The tax refunds have helped. But we would expect that consumers will become a lot more intentional with their spending if you see this continuation of the conflict and gasoline prices continue to rise.
It's not hurting at all the equity index rally that we've seen over the past, now 8 weeks in a row of gains, the longest streak of weekly wins since 2023. Does anything matter outside of AI demand?
No, as you said, it's tremendous. The way that the equity market has completely brushed off concerns around the conflict concerns from consumer confidence surveys, inflation expectations. And as you said, they're focusing on earnings growth broadly because it hasn't just been focused on tech companies. You've seen a real broadening in this strong earnings performance. But most importantly, it's down to AI. And that continued spending that we're seeing from these companies is really driving it forward, which is important because, from a narrative perspective, AI is fairly macro agnostic. So this is an area which can hopefully continue to do well, even if the conflict gets worse.
I hate to ask Seema about concentration risk because it's something that we've been talking about, it seems like, for years now. But it's so hard to ignore when you look at the outperformance of the S&P versus the equal weighted index. It's almost double the gains year to date. How do you, as an investor, view that?
Yeah, this is, I think, for us, one of the key questions. We talk about diversification all the time, but the question is, how do you really diversify when AI is actually a part of so many different companies, so many different sectors? Increasingly from a regional perspective, last year, the key diversifier against this AI trade was Europe. But certainly with the conflict, given that Europe is the most exposed region, it's not the most attractive. So we look across to Asia, and of course, there's still the exposure to the US there, with the exception of China, which has almost its own ecosystem, and on top of that is less exposed to the conflict. So we do continue to like China. But overall, from a macro perspective, it's very difficult to find any other really key diversifiers, which takes you back to the idea that in this kind of environment, when there is so much concentration, it becomes so important for investors to try the bottom-up approach, really seeking out companies that have got that diversification, have still got strong balance sheets that can withstand some of the headwinds. But certainly it is a challenging story when the concentration is as much as it is today.
Seema, aside from the University of Michigan, the other big headline that we've got this hour is Chris Waller. He thinks they should remove the easing bias from the statement and that we may even see a rate increase. This an hour ahead of Kevin Warsh being sworn in as the new Fed chair. And we know that the president desperately wants rate cuts here. How much do rates matter? It seemed for a moment this week and last week that we could see higher rates cause problems for this incredible equity index rally, but we are seeing rates now dissipate a little bit, and it doesn't seem to be front and center anymore post Nvidia earnings.
I think the rate story is important to some extent, but as you said, really it's so much about the AI story and earnings. Now, if you were to see a shift to Fed hikes, not just because of strong growth, but actually because of inflation expectation concerns, well, then the story could change slightly, but probably not for the tech companies, unless you get a very, very steep increase. So again, it does become a lot about which sectors do you have exposure to. You want to have exposure to tech if you can continue to see the bond yield move, because investors can continue to buy into that productivity story. But certainly it is difficult. And I think the news around with what Chris Waller has just said is really important, because remember, it was his dovishness which had driven some of the more dovish expectations from the market about 6 or 7 months ago. So this is actually very key to the discussion around how the Fed is going to move forward with rates going forward.
Of course, most people do have incredible exposure to tech just because of that concentration. And, your average American invested with a 401k, or, if you're part of a pension plan that's managed by CalPERS or TIAA-CREF, you've got, you're tracking the index. Are you going to see a broadening out of these indexes in terms of performance? We have seen earnings margins expand for at least 7 of the 11 industry groups in the S&P 500.
Yeah, it's been a really impressive performance almost across the board. And I think that's important to note. As you said, the performance has been very much focused on technology. If these companies can continue to move forward, continue to deliver strong earnings, and of course that is so much dependent on the conflict and how oil prices move from here. But if they can, then certainly we would expect there to be a broadening out over time. But the truth is that tech is likely to stay the lead performer, even as other sectors maybe join into that rally.
All right, Seema, great having you on the program. Really appreciate your time this morning. have a fantastic weekend. Seema Shah there of Principal Asset Management. Let's get a look quickly at the markets. Just about 40 minutes into the session, we're looking at gains on the S&P, 33.5 points to 74.79. The NASDAQ up 134 points to 29,496. Both of them gaining about 0.5% right now as yields hold, well, at least 10 basis points lower than we saw than hit earlier this week. Right now at 456, 457, and Brent crude, although it's up $1.69 at 104.27, is still lower than it's been throughout most of the week. Let's get a look at some of the single stock stories at this hour. Workday earnings topped expectations. That defies fears around AI's impact on the software company. We're also watching Estée Lauder shares after talks to merge with the Puig brand fell apart, and looks like Estée Lauder shareholders like that. And Ross Stores reported better than expected sales and boosted its full-year forecast, driven by strong customer traffic. That's good news as the University of Michigan consumer sentiment falls to its lowest level of all time. Coming up, the Justice Department telling senators President Trump will not receive payments from a new government weaponization fund or anti-weaponization fund. We'll get the details next from David Westin ahead of his Wall Street Week program this evening. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. The United Arab Emirates is joining Saudi Arabia and Qatar in urging President Trump to end the war with Iran, fearing renewed attacks could devastate Gulf economies and energy exports. Gulf leaders say diplomacy and not military strikes is the only path to curbing Tehran's nuclear ambitions and missile threats as tensions remain high after the recent ceasefire. New York Stock Exchange President Lynn Martin is criticizing exchange rule changes that are aimed at attracting major IPOs like SpaceX. She joined Bloomberg Surveillance.
Market integrity is not something that is a competitive dynamic, and some of the rules that have been changed to woo some of the large companies, you referenced SpaceX, are questionable. And from our perspective, what is most important to us is protecting investors. To be honest, I just don't know what effect this is going to have on the market.
And to be clear, she is criticizing the NASDAQ, which earlier this year changed its listing rules in order to slash the time it takes for a newly listed large cap company to enter its main index. Now, as little as 15 days. The Justice Department says President Trump and his sons won't profit from a proposed $1.8 billion weaponization compensation fund. A DOJ memo says payments could go to people targeted by government investigations, including senators whose records were secretly subpoenaed. GOP. And I want to. My mic died? My mic died.
Mine did.
Okay, take two. The Justice Department says President Trump and his sons won't profit from a proposed $1.8 billion weaponization compensation fund. A DOJ memo says payments could go instead to people targeted by government investigations, including senators whose records were secretly subpoenaed, as well as Proud Boys and Oath Keepers who attacked the Capitol on January 6th. GOP lawmakers remain divided over the oversight and how the fund would operate. Let's get more on the weaponization fund with Bloomberg Wall Street Week host David Westin. David, I thought it was interesting. Yesterday, Balance of Power was talking with Shelley Moore Capito, also a Republican, and she said she still, after spending some time with the Justice Department, has a lot of unanswered questions about how this fund would work.
Yeah, which may be a feature rather than a bug. I mean, I'm not sure how specific they want to be and how explicit. I mean, I'm trained as a lawyer. I practice as a lawyer. I think it's almost a disadvantage on something like this because when they say it's unprecedented, this is beyond unprecedented. We've never seen anything like this. Nobody anticipated. So it's really hard to know whether this is legal, not legal, constitutional, not constitutional. It's really hard to know how it's going to work.
One of the issues is that you could get payments to some of the people who attacked the Capitol on January 6th and even injured police officers, and now you have a couple of police officers suing to try and block this.
Exactly right. They have already filed lawsuit, and their argument, as I understand it, is this could encourage further attacks like this because it's giving them impunity, even maybe subsidizing it, and we might be at risk again. But it goes to a central issue that you know well, Matt, which is in order to bring a lawsuit against something like this, you have to have something called standing, which is mean that you have a personal interest where you may be harmed, and they have an argument for it, but it's a bit attenuated. And this Supreme Court has been cutting back and cutting back and cutting back on the category of people who can bring these lawsuits. So apart from whether it's legal or not, or constitutional or not, it's not clear it can even get to court.
The question about constitutionality, I think, is especially interesting because of the appropriations clause in Article 1. Obviously, they have some freedom over what the executive branch can appropriate in the judgment fund, as you've pointed out. We've been talking about this, but the question is, does this fall under that umbrella? I mean, it's $1.8 billion in taxpayer money.
Yeah, I mean, normally the Constitution says that Congress has to appropriate money, and certainly 1.776, an interesting number, right? $1 billion they should be appropriating. But back in the 1950s, Congress passed a law that said the Justice Department can create a judgment fund, which they have, and they can pay judgments out of it, which makes sense if you think about it. You don't want them to have to go back to Congress every time the Justice Department settles any kind of a lawsuit. And so they could use that sort of money. By its terms, it looks like it would cover this. I mean, some people could argue that this is outside the norm, in part because, as you know so well, Matt, I don't know we've had a president settling with himself.
Yes.
He brings a lawsuit against himself, and then he negotiates with himself about how to settle a lawsuit. We're on territory we've never dreamed of.
And this is precisely what constitutional law professor David Super at Georgetown has argued. This wouldn't be allowed under the judgment fund because of the collusive nature of the settlement, right? President Trump suing the IRS, an organization that he's in charge of, and the dealing with the DOJ, an organization that he's in charge of, and he decides essentially all of these things arbitrarily.
And listen, it sounds on its face, I mean, deeply questionable and objectionable. But actually, Professor Super should go down the hallway and talk to Professor Vladeck, who's also a constitutional, who said, you know what, I think this probably is okay under the judgment fund because Congress has given a lot of discretion to the Justice Department and the executive branch to settle these lawsuits. They have a lot of discretion. So who knows? We don't know what it's going to be. But it's clear that there's a lot of objections. You hear actually Republicans now in Congress really bringing objections up. Whether they really mean to pursue them or not, it's objectionable. But the main point, and I've said this repeatedly, is not everything that is foolish, outrageous, objectionable, unethical is illegal. You know, there has to be a law, there has to be a statute or a provision in the Constitution, and it's not absolutely clear to me what exactly it is.
It does seem as though the administration has avoided the courts here. They came to the settlement one day before they were due to hand over some evidence to a court. And the idea, I think, now is that they're going to try and spend this money as quickly as they can so that it cannot be undone later.
And just to wallow in civil procedure here, one of the issues here, they'll have that money. If they start writing checks, people start cashing and start spending the money, it gets harder and harder to undo that. So you'd have to go into court and get a temporary restraining order or preliminary injunction. And one of the criteria for that, of course, is likelihood of success on the merits. And even if at the end of the day, maybe you could win this lawsuit, I'm not sure at the outset it's so clear that a court would step in and give a TRO. We'll see.
One of the biggest objections beyond paying out, this money to January 6th rioters is that the president has also managed to give himself essentially a pardon in perpetuity. And not just himself, but his companies and his family members, it seems, now can no longer ever face not only audits by the IRS, but any lawsuits by the federal government.
Yeah, I mean, again, we've never seen anything like this before. And in some ways, that could be even more dangerous than anything else. Historically, as you know, Matt, the president has been very reluctant to interfere with IRS enforcement actions, audits, actions taken. But this is basically, it seems like a get-out-of-jail-free card, not to say anybody going to jail, but a very broad sort of immunity, prospectively, for anything that could happen. We haven't seen this before, and there'll be a lot of objections. But in the end, It's up to the people to decide these things politically, and their representatives in Congress through impeachment. If people object that much, that's the way the system's set up. And if Congress doesn't want to step up to the plate and really address this thing, and the people don't want to step up to the plate, then that's the way the system's supposed to work. I mean, as you know, Chief Justice Roberts wrote this in the Obamacare case. He said it's not our job at the Supreme Court to undo political decisions. If they decide that politically, the people decide it, then that's the way democracy works.
All right, well, I know these things because I talk to you about them so often. David Westin there, anchor of Wall Street Week. You can catch Bloomberg Wall Street Week every Friday at 6 p.m. New York time. I also recommend listening to June Grasso's radio program, Bloomberg Law, weekdays at 6:30 p.m. on Bloomberg Radio. You can get that on Sirius XM channel 121. Let's get a check on what's going on in the markets right now. We're seeing a continued rally right now, up 25 points on the S&P 500 to 7,470. The NASDAQ gaining about 1/3% to 29,462 as rates look a little bit lower than they were earlier in the week. We had gone to 465 and then some on the 10-year. Now we're trading at 457. Brent crude trading at 104.31. Coming up, Axon shares stumble after a big run up. The company's president, Josh Isner, joins us next on AI and the future of public safety technology. Axon shares have come under pressure this year despite beating first quarter profit expectations. The company is also expanding and has long been expanding beyond tasers and body cameras and pushing deeper into artificial intelligence for public safety software. Joining us now is Axon president Josh Isner. Josh, it's great to have you on the program. I've been following your company for a while now, and yours is one of the first use cases that I really understood for AI in terms of helping law enforcement officers do their jobs more efficiently. So I'm surprised to see you get drawn into the whole SaaSpocalypse universe here. Why do you think the market is getting this wrong?
Sure thing, yeah, and thank you for having me. I would say, look, we've built a very diversified business, but we started out as a taser company up until about 2009, 2010, and not only do we still sell tasers to public safety, but we also have built a very large software business, and we are very proud of that. We manage about 40 times as much data as the entire Netflix library. We've built this application that public safety depends on for all of their situational awareness and evidence management. And sometimes, when you work really hard to build a massive software business, you kind of get dragged into the basket. And, we look at this as a moment in time. The company's grown 25+% for 7 straight years. We've grown 30+% the last 3. We're very, very excited about the last couple quarters we've delivered. And we'll ride out the wave because at the end of the day, there's a very diverse business across not only software, but we have a massive hardware business. We're the market leader in public safety and AI. We booked almost $1 billion last year in AI products in our first year of selling them to our customers. And so we look at this as a moment in time, and we're going to continue to execute and deliver incredible top-line growth to our investors as well as profitability, and we'll ride out the storm.
It's incredible, the growth figures, 25% annual growth over years. That's now accelerated to 30% as more and more law enforcement agencies start adopting this technology. And doesn't it go beyond, just police forces? I mean, and fire departments to even military applications?
Absolutely. So our core business is U.S. public safety, but on top of that, we have a growing federal business, we have an exploding international business, and we have this enterprise business, which is more like businesses buying some of our video situational awareness products. Large retailers are wearing body cameras now. Our counter drone products are protecting data centers and warehouses and logistical facilities. So again, it's one where our products have great product market fit across a number of industries, and all of them are really growing. So,
what's your view on the cost side of AI? There have been increasingly questions about how expensive it is for companies like yours, like Uber, for example, to be using all of these tokens. Obviously, that cost per token number has to come down in the future, but what does it look like to you now?
Sure, I think we're still getting a lot of tailwinds out of it, and we're very safe in how we budget and how we guide our investors. And so a lot of these assumptions was built in, not only on the AI side, but on the memory side this year as well, as we continue to ship more and more hardware. And so, yeah, we're feeling really good about where we're positioned, and ultimately the value that we're delivering in these AI products to our customers certainly justifies the cost we're paying in development.
I know that most of your time has to be spent on products and clients. How often do you get to actually spend with shareholders? Because it seems like investor communications must be ultra important at times like this.
Absolutely. And I'd say again, like we are, as a high growth company, we're kind of used to the roller coaster. And so we've got iron stomachs. We try to keep our heads down and do the same things that have delivered incredible value over the last 5 or 10 years here. And so I do spend a lot of time with shareholders. They're very supportive. Almost, I think about 85% of Axon is owned by institutional investors. So, and a lot of them have built up their positions over the last quarter as the stock has gone down. And so I think we have a lot of support for our investors. They know that, they can rely on us to deliver. And so, sure, I spend a fair amount of time with them.
Do you have to continue to be investing aggressively in R&D? Do you have to continue to be investing in customer satisfaction, retaining customers?
Of course. Yeah. And that's kind of our superpower. The way we grow revenue is smartly investing in these new opportunities across new markets and across new products. And so the biggest thing for us is having a high hit rate on those investments. And, the last 5 years have shown that's happened. And we think into the future with all of the AI bets we've made and the infrastructure bets we've made and the hardware bets we've made, we're really well positioned to deliver a lot of value across each of those categories.
One of the things I've noticed is that with all of these AI tools, it's difficult for a lot of times employees, and in your case, clients, right, to keep up with training. Mm-hmm. How do you deal with that? Because I imagine police officers, for example, who have so many other things to do, don't have time to sit for seminars.
Ultimately, our customers trust us as the vendor that delivers disruptive products into public safety. So whereas a customer without a big trusted brand in public safety comes in with AI, I think there's some skepticism. When we show up, our customers know at the end of the day, Axon will not let them fail. And we've proven that time and time again. And so we've got the deployment mechanism down on these AI products, and that's why we see the scale we do right now.
All right, Josh, great having you in the studio. Thanks so much for joining us. Josh Isner who's the president of Axon. Let's get a check right now on what's going on in these markets as we see a rally in the early trading, 74.76 on the S&P 500 right now, a gain of 0.4%. The NASDAQ up a little bit more than 0.5%. And I'll remind you again that this will be the 8th week in a row of gains. That's the longest weekly winning streak that we've seen since 2023. It helps that yields are a little bit lower right now at 4.57, although still over 4.50. Brent crude still over $100, but lower than it has been this week at $104.12 a barrel. Let's get a look at some of the single stock stories that we're following for you. I'm looking closely at Stellantis. It is rebooting the Chrysler brand with 3 new SUVs. 2 of them are priced under $30,000 a piece as inflation really starts to squeeze car buyers, or has really been for a number of years now. Take-Two is sinking as weaker bookings guidance overshadows beats on other key metrics. The video game maker also confirmed a November 19th release date for Grand Theft Auto 6, and the Wall Street Journal reporting that IMAX is exploring a sale and has approached entertainment companies as potential buyers. You can see IMAX shares up now 14%. Coming up next, we speak to Atomic Invest CEO David Dindi on why the future of investing may live inside AI companions and not on the apps that are so dominant today. This is Bloomberg Open Interest. Now, Atomic Invest CEO David Dindi believes we're entering the biggest interface shift in financial services since the smartphone. He says the next battle in finance won't be between apps, it'll be between AI companions. And he joins us, I'm proud to say now. David, thanks so much for coming to New York and sitting with us for a little bit. I am fascinated by the idea of AI companions and the application of this technology for so many things in our daily lives. You think it's going to start trading stocks for us?
I think so. I think it's already happening right now. Many people are using AI to start their investing research. I think in the next coming years, you'll start to see people start to delegate the authority to manage their accounts to these AI companions. I would actually say in 5 to 10 years' time, it's unlikely that you will actually go to an investing app to manage your account. I don't think investing apps will exist in their current form. I think it'll be an AI companion that's doing that for you instead.
So what would you have to do, though? I mean, an AI companion, I imagine, would still have to plug into some sort of investment platform like Atomic or Interactive Brokers or Robinhood, and able to make trades and buy and sell shares, custody its assets. How does that work?
Yeah, you're right in the sense that even though the interface layer changes, even though you're moving away from people accessing these services from apps, the underlying activity of accessing the securities market still has to happen through regulated institutions. And likely that could be, your existing broker-dealer where your AI companion gives you access to your account through their interface. Or it could be that the AI companion itself partners with an institution that's similar to Atomic that enables them to offer these services natively, and that provides a regulatory coverage under which this activity can occur.
And so this is exactly why I think the news on Fed master accounts is so interesting. Because of the president's recent executive order, more fintech companies like yours could offer this kind of service to consumers.
Yeah, if you think about what happens underneath the hood in fintech, most of the innovation that you've seen around neobanks and payments applications are really built on the bank sponsorship model. So as a fintech, you have to find a bank partner to be able to access the Fed payments network or to hold deposits. But this shift essentially allows a fintech that's appropriately regulated to be able to have direct access to the Fed master account. And so that means from a cost perspective, from an infrastructure perspective, from like a speed perspective, things will be a lot more smoother than they are today as a result of eliminating the need for this underlying dependence.
So what are you doing in terms of R&D when it comes to AI?
I think that where we operate as a company is at the infrastructure layer. So we essentially provide the infrastructure to allow companies to innovate on top of us, build AI solutions, build even non-AI solutions there. So our value is really around the regulatory coverage, access to the market infrastructure for builders and developers to build on top of ours. And so we are making our ecosystem a lot more friendly to AI applications as well as to companion systems that might use us in this particular way.
Are there any companion systems already out there that you see as particularly useful or successful?
Well, I think in the last couple of months, you've seen a number of frontier labs and AI chat companies start to integrate some degree of financial analysis and financial visibility for their clients. So for instance, ChatGPT recently announced a partnership with Plaid for you to be able to access your financial portfolio. Perplexity has had a partnership with Plaid as well for you to be able to see your Robinhood accounts and trade in that respect. So I think we're in that first phase where people are using these systems to have better visibility into their accounts, ask questions. But we're still some ways away from being able to take long-term actions such as managing portfolios, planning for people, and allowing people to delegate that authority to these systems completely.
But the bottom line is you see these companions being developed not by Atomic or by Robinhood, but by Anthropic or by OpenAI in partnership with your platform.
So I think that there are two worlds, right? One world is to say a Robinhood might develop a companion, which they have today. They have a companion called Cortex that can help you trade in your account. But that is a siloed companion, so to speak, that exists in the Robinhood context. I think the more powerful play here would be for a companion system that services you across many different dimensions of your life, helps you book tickets, helps you understand, for instance, if you're planning a diet, how to do that. But then at the same time can also be a personal CFO. And the reason for that is that it can operate across multiple buckets of your life, as opposed to the first-party agents that are built by these platforms that only ever see the information that you have on their platform.
So I need a companion. I'm going to have a baby this year.
Yeah.
And I need a companion to help me set up my Trump account. How soon is it going to come? Like, am I going to have to figure out how to do it myself?
Well, first of all, it's coming in this July, so you'll be able to open Trump accounts this July, I believe. The next question is, when will you be able to roll it over to your existing brokerage account versus using the account that's established with the Treasury? That's likely to follow perhaps towards the end of this year or next year. And, I'm looking forward to you having your baby, and we can, talk together about how we can open that Trump account through a number of our partners that are going to be launching the solution as well.
I mean, Atomic is going to be doing big business with Trump accounts.
We are.
And how do you see it turning out?
In terms of
your business, I mean, how do you think it's going to be accepted? How many people are going to be opening these? Is it going to be broadly used?
I think it's going to be a big acquisition hook for the companies that we partner with, because now they can engage with their members and their clients on a different dimension, which is to really help them get access to these accounts. And for the children that are actually born, in 2025 and 2026, where there's that $1,000 benefit, I think that's something which most parents would look to try to get access to. So I do think that for our business, it will be a boon. We do have a number of partners that are actually going to be launching these Trump accounts as well that I'll be happy to share with you in time, that I think will really make for expanded access to this innovation for many people.
All right, David, great having you here in the studio. Thank you so much for joining us. That was Atomic Invest CEO and co-founder David Dindi. Coming up, Kevin Warsh is set to be sworn in as the 17th chair of the Federal Reserve. We'll push ahead to the White House ceremony kicking off at 11 a.m. Eastern. This is Bloomberg Open Interest.
But I can no longer rule out rate hikes further down the road if inflation does not abate soon. And that is especially true if measures of inflation expectations, some of which have risen lately, show signs of becoming unanchored.
Fed Governor Christopher Waller speaking at the Frankfurt School of Management, Finance and Management about the Fed's next move as the energy shock from the Iran war pushes up prices. Let's get a look at what's ahead for markets today and next week. At 11 a.m. New York time, Kevin Warsh set to be sworn in as Fed chair in a White House ceremony. Monday, U.S. markets close for Memorial Day. Tuesday, we get Conference Board consumer confidence data after the horrible consumer confidence data we got from the University of Michigan today. Wednesday, Salesforce earnings. Thursday, core PCE and results from Dell. And right now, I want to get more on both the Kevin Warsh swearing-in ceremony, what to expect from the Federal Reserve as he takes over as chair, as well as the UMICH data, because I think we have a really interesting breakdown here on the Bloomberg terminal. Bloomberg economist Stuart Paul joins us here on set. I mentioned UMICH because we have, if you type in WSL UMICH on the terminal, Michael McDonough has put together a fantastic breakdown. And, the number came in, Stuart, at an all-time low, right? But if you look at the difference between what Republicans replied with and Democrats reply with, it is shockingly dispersed. So Republicans have an 84.6% level of confidence, which is fantastic. Democrats 32.8%, which is awful. I mean, this is just the way we are right now.
Yeah, when I write up the UMICH data twice a month, you have the preliminary and then you have the final every month. Every now and then I'll include a chart that shows sentiment broken down by political party, and it flips every time a new president takes office. So if you go back to the Biden administration, you would see much more positive sentiment among Democrats than you did among Republicans. Now you see the exact opposite. It's a very standard development that takes place throughout the political cycle. The thing that I always like to look at within the UMICH report really is buying plans. We know that inflation matters a lot. We know that inflation weighs on sentiment, especially in UMICH. It matters much more in UMICH than in the Conference Board, which we'll get next week. But within UMICH, the thing that matters most to me is buying plans, because it speaks to just how much price pressures are forcing people to tighten their belt on other household expenses. And when you see buying plans for major household durables declining, that's what really sends a signal to me more than anything else, really.
What signal do you think it sends to Kevin Warsh? I mean, clearly the president has put him in place because the President wants him to cut rates and must think he's going to at least try and do that, right?
Right.
But Warsh is historically hawkish, and actually your colleague Anna Wong thinks that he's going to prove to be a hawkish Fed chair.
It's really interesting that his opening statement during his Senate banking confirmation hearing, he included a line that inflation is always a choice. Now, we're living in a world that has supply shocks and everything from chips to aluminum to energy out of the Middle East. And he's saying that inflation is a choice by central bankers. That is a very hawkish sign as far as I'm concerned. Now, what the UMICH data signal and what spending data signal is that households are becoming a bit more discerning in their spending plans. When that's the case, inflation pressures become a little bit less pervasive. The risk of inflation broadening starts to decline a little bit. But we also know that central bankers, including Christopher Waller just this morning, are really paying attention to exactly that. Inflation diffusion, the broadening of inflation pressures. But again, when you see data like we did this morning, when households are starting to tighten their belts a little bit, when buying plans start to deteriorate, that risk of broadening inflation starts dissipating. And so what does that really mean? It means that the need for hikes is certainly not urgent, and the Fed can afford to wait. In fact, when you see bonds sell off, when you see financing conditions and financial conditions tightening, the Fed can afford to wait because the market is doing some of the heavy lifting here.
I have to ask you a little bit of a curveball here, Stu. I have to ask you, as a learned economist from George Mason University, what you think of a gas tax holiday. We were talking yesterday with Jared Agan, who is the executive director of the National Energy Dominance Council, and he said this is something that President Trump is going to do to bring prices down. And to me, it doesn't make sense why you would subsidize demand if you have constrained supply. Doesn't that drive the price higher in the end?
No, you're exactly right. And forcing something like a policy change, which is more structural in nature on a temporary problem, really actually just does the exact opposite of what at least central bankers want to see, which is narrowing inflation pressures, not broadening inflation pressures. If you end up offering some sort of a gas tax holiday, it certainly doesn't address the supply constraints, as you mentioned, and it puts a little bit more money in people's pockets to start bidding up the prices of other goods and services. While that might be relatively useful in the abstract, sort of theoretical balancing of relative prices, in a practical sense, in a policy sense, it doesn't actually help to address the inflation problem. In fact, it risks broadening inflation pressures, which is not what central bankers want to see.
Stu, great to get to spend some time with you. Thank you so much for joining us. Stuart Paul there of Bloomberg Economics. You can type, by the way, on your terminal, BEGO, to get access to the Bloomberg Economics news and analysis platform. Let's get a check at what's going on with the markets an hour and a half into the session. We're still looking at gains on the S&P 500 and the NASDAQ. So we're going to see 8 consecutive weeks of gains for these equity indexes. We see the 10-year yield at 457, 458, so not as high as it had been earlier in the week, and crude isn't either at 104.18. Have a fantastic Memorial Day weekend. Coming up on Tuesday, Marta Norton joins us from Empower, Joanne Feeney of Advisors Capital Management, and Cyrus One CEO Eric Schwartz.